Hello and welcome back to Intertax Learning. Today, I'd like to introduce my favorite acronym in international tax, BEAT. I like BEAT because it has an impact. It captures the shock when a company gets hit with an extra tax for what seems like a harmless deductible payment. Let me show you how it works. BEAT stands for Base Erosion and Anti-Abuse Tax. BEAT is like standing on a desert platform. Your taxable income is the platform. Your related party deductible payments are the shifting sands that erode that platform. To enter the BEAT territory, the U.S. corporation must pass two tests. First, the entire control group has to have at least an average of 500 million annual gross receipts in the previous 3 years. If your company isn't big enough, BEAT doesn't apply. Second, the base erosion payment has to be at least 3% over all deductible amounts. Only when both requirements are met, BEAT applies. Therefore, BEAT is a minimum tax regime that applies when large U.S. corporations reduce their U.S. tax base by making deductible payments to foreign-related parties. Common examples of base erosion payments include interest, royalties, service fees, and certain reinsurance premiums. Notice these are payments for things that are too easily to move offshore. In other words, easily mobilized items. BEAT is the regime that's used to neutralize these deductions. BEAT is calculated as 10 times taxable income after adding back the base erosion payments. If BEAT is greater than regular tax, then the difference is a top-up tax. Beware that because of the OBA, a permanent rate of 10.5% will be used starting in 2026 instead of the current 10%. Let's see an example. A U.S. corporation is owned by a foreign parenting company. Foreign parent infused U.S. subco with equity and U.S. sub is to pay an annual interest. Let's look at U.S. sub's financials. Revenue is $800K. Operating expense is $400K. Depreciation is $100K. Interest to foreign parent is $200K. Interest to U.S. bank is $20K. Other deductible expense is $30K. To calculate overall deductible amount, we add up all of the above expenses, which sum up to $750K. The $200K paid to foreign parent is a base erosion payment. To clarify, the interest paid to U.S. bank is not a base erosion payment because U.S. bank is not a related party. Base erosion payment of $200K divided by overall deduction of $750K equals to 26.7. It is higher than 3%. Now, assume the group's revenue meets the 500 million threshold. Both tests are met. Therefore, BEAT applies. So, how do we calculate BEAT? BEAT is equal to 10% of taxable income after adding back the base erosion payment. We know the base erosion payment is $200K. We still need the taxable income. In this case, revenue minus deductible expense equals to $50K. That's our taxable income. Tentative BEAT is 10 times $250K, which is $25K. Now that we have the tentative BEAT, we need to compare it with regular income tax. Assume a U.S. corporate income tax rate of 21%. Regular income tax is $10,500. In this case, tentative BEAT is greater than regular tax, so the difference of $14,500 is the top-up tax. To understand BEAT fully, let's see what will happen if we reduce the base erosion payment to only $20K. Also, assume that operating expense is increased to $580K. So overall deduction remains $750K. In this case, the base erosion percentage is only 2.7%, less than the 3% threshold. Therefore, no BEAT applies. You can see here that an immaterial amount of base erosion payment is generally not penalized. Alright, that's it for this lesson. Today we talked about two tests to qualify for BEAT and how BEAT applies when base erosion payment is too high. BEAT is one of the U.S. minimum tax regimes. The U.S. also has a corporate alternative minimum tax, or CAMT, which we'll talk about in our next video. I hope you stay tuned for the next one. Thanks for watching Intertax Learning, where we make international tax simple, one concept at a time.